So first we will start with mutual fund. Mutual fund. So actually mutual funds are the mediators between people and stock exchange. So just write one line, I'll explain this. Mediator between people and stock exchange. So what they do, they collect money from the people and they invest in stock exchange. Okay, now how they collect money? They sell their units. They sell their units and they collect money. So people can buy the units and mutual funds will collect the money, and this money is what you call as corpus. And they invest this corpus in stock exchange. Okay, so mutual fund is actually a mediator between the public and the stock exchange, or the investor and the stock exchange. So it is like this. Public, if you have a very good knowledge in stock exchange and if you have a very good knowledge in trading, you can directly do that. But if you are not having good knowledge in economy, good knowledge in stock exchange, you need the help of this. Because stock exchange, the return is high, but it is very risky, right? So you will approach the mutual fund. So you will buy their units, okay, and you will give money. So that will be invested in stock exchange. So here mutual fund is actually acting as the intermediary. Okay, now mutual fund will sell what? Units. Let's say one unit is rupee 10. Okay, so let's say 1 crore units are sold. So 1 crore units are sold means they have mobilized how much? 10 crore. So this 10 crore is your corpus, right? So this corpus will be invested in the stock exchange. You got the idea? So public will pay money to a mutual fund. They will invest the money in the stock exchange. So they are actually the mediator. Now how they raise money, how you get this? They sell units to the public and they raise the corpus that they will invest in stock exchange. Okay, now there will be experts in the mutual fund who's deciding where to invest, which share to be bought, etc. Okay, so that expert is what we call as asset management company. If you remember when we discussed about NPS, I've talked about asset management company. I've told you this is not a separate company. There will be a wing in every mutual fund, right? Asset management company is a part of that mutual fund which is taking care of the assets. What are the assets of the mutual fund? It is nothing but the shares and bonds. So they are going to invest in shares and bonds. So these section is going to take the decision with respect to this. So that is why asset management company. So this section is what actually managing the assets, which are nothing but the shares and bonds of the company. Okay, so every mutual fund will have their own AMC. Okay, so they will decide which share to be bought, which bonds to be bought, what should be the proportion. So share could be 60-40. So this is slightly more risky. When proportion of share is more means it is more risky, or it could be 40-60. And if you remember, in case of NPS, I have given you one ratio. Okay, I think 40-60 is what I have given to you. But there it was long term, no? So it is, even the share is also very safe. Okay, and they will go for diverse investments. It's not that only in one company they will invest. So diverse investment, they will identify those companies whose fundamentals are strong. So asset management company, they will do all this fundamental analysis of the company. They will take care of the technical analysis of the company. So how the company is going to perform in the future. So everything is done well, and only after that they are going to select those shares in which they are going to invest. Okay, so understand, asset management company is not a separate company. It is a wing within the mutual fund. Now, what the public will get? Now, what the public will get? Public will get the return in two form. They will get firstly dividend. Okay, because ultimately what you are doing, you are purchasing the shares. So from shares you will get dividend, right? So one return is actually dividend. And in case of bonds, they will get the interest, right? So interest on bonds and dividend from share. So I've told you this ratio. So let's suppose this is share. So from here you will get dividend, from here you will get the interest. Okay, so now from this return, whatever you got, there will be some commission. So that commission will be deducted and will be given to the public. So they are just acting as the mediator between the public and the stock exchange. So whatever is the commission, that will be deducted and will be paying it back to you, and it is more safe rather than you investing directly to stock exchange. Okay. Now the return can be in another way also. So see, I've told you first is actually income. The return could be in income, like income can be what I've told you, dividend on one hand, and interest, right? And interest. See, here there are different options. It's up to you to decide in which proportion you need to. It can be 60-40, it can be 90-10 if this is share and this is bond. So this is more risky, right? If it is 20-80, this is less risky. So for example, like old people, this will be suffered, and young people, this will be preferred. Okay, and young people, anything is okay, they can take that risk also. So it's up to the individual. That's why you can see in the advertisements, mutual funds are subjected to market risk and everything. So that proportion you can actually choose, and based on different proportion, there are different schemes within the mutual fund. Okay, now the return I'm saying, it could be income could be dividend and the interest. Secondly, I've told you they sell their unit, right? So they sell their unit to collect money. Over a period of time, what will happen? This value of unit will change. Like share price, let's suppose you are buying the share of TCS at 300 rupee. Okay, so here dividend I am talking about, not this 300 rupee will change to 400. So this is the share value change. Okay, so share value change. So when the share value change, the entire corpus will change. This dividend is actually different thing, that is a profit of the company. Apart from that, the share value will also change. So corpus will change. That means, let's suppose 10 crore was the initial corpus, and now it is, let's say, 12 crore. Okay, let's suppose how much units was issued? 10 crore, right? Or 1 crore, right? How much it was before I told you how much? How much units are issued?
1 crore, sir.
1 crore, okay. Okay. So now so 1 crore. So what is the value of unit? Now 1.2, right? No, 12 rupee, right? 12 rupee, right? So 1 unit before it is 10 crore, no, 10 rupee. Where I've told that. So what was the cost of 1 unit?
10 rupee.
10 rupee, right? So
Yes.
I don't know, I don't remember what I told you. I think I've told you 10 rupee and 1 crore unit issued. So 10 crore mobilized, right? Now this 10 crore was invested, let's suppose this share 300. Now that price is increased. So this 10 crore will become, let's say, 12 crore. But units remain the same, right? So 1 unit now will cost how much? 12. So if, let's suppose, you hold 100 units, you were given 1000 before, now you will be getting 1200. So there is a change in unit. Okay, change in value of unit. This is what you call as capital gain, right? There is a capital gain. So value of unit change, that is capital gain. And this is also known as NAV, net asset value. Net asset value. So the unit in the mutual fund is actually called as NAV. So the NAV value change, NAV value change. Any doubt here? This unit concept which I have discussed. This part, dividend. Dividend, I am expecting that you know this, right? 300 rupees is the cost of share for TCS today. Okay. After some time, based on the demand supply, this will increase. So let's say this is increased to 400. So you can sell and you can get 400. But apart from that, when the TCS issue, their dividends are issued separately, no? Every quarter they will issue dividend, or every year you'll get the dividend. So that is different. So here I am talking about that return in from the dividend. Then bonds interest. This is net asset value also changing. Are we okay with this? Any doubt here?
Sir, please explain it again.
Yeah, I am saying, let's suppose you are buying a share for 100 rupee. One share of TCS is costing 100 rupee. Now, after, let's say, 1 month, this share price has increased to 200 rupee. So what you can do now, you can sell this share, right? And you will get how much? 200. So 200 minus the price at which you bought 100, that is your return, right? This 100 is your return. Correct, no? So this is what you call as capital gain. and we will discuss about this in detail when we discuss about tax, capital gain tax, etc. But this is capital gain in the capital. This was your capital, and now this is what you are getting. So there is a increase. Apart from that, let's suppose if you are holding this share of TCS, let's say one share. This is one share, and imagine during this time you are holding the share, TCS made a profit of, let's say, 10 lakh. Okay, TCS made a profit of 10 lakh, and let's say out of it, the 3 lakh is paid as corporate income tax. Balance 7 lakh is there. This 7 lakh is the profit which is to be distributed. This will be distributed among the shareholders. Let's say 1 lakh shareholders are there. 1 lakh shareholders are there. So every shareholder will get how much? 7 rupee, right? So you are holding how many share? You are holding one share. So you will get how much? 7 rupee. So 7 rupee that you are getting is the dividend. Are you getting me, Anjali? This is dividend.
Yes, sir.
And this change is what? This is the increase in share price in the market. So this is actually market mechanism. This is the company's profit, which is dividend. So both way you will get the benefit. That's what I'm saying.
Okay, sir.
So here when the share price change, the NAV value change. Yeah, tell me.
So NAV, the 200 is 100 is the capital gain. The NAV is also the capital, the 100 rupees only.
No. NAV is actually changing. NAV is actually the net asset value, the unit value. The 10
New value.
Unit value.
Okay, got it.
Unit
Yeah,
value.
Got it.
The units you call as NAV.
Yeah.
So if you want to, you can just write an equation also. NAV is actually total asset, and not NAV, total asset divided by number of units. Net asset value, NAV, total asset divided by number of units. In the first case 10 crore, in the second case 12 crore. So number of units is how much? Number of units was how much? 1 crore, right? 1 crore and 1 crore. So here NAV is 10, here NAV is 12. I am saying the unit value is 10, unit value is 12. NAV is actually the technical word of the unit that you are selling. 1 unit 10, now 1 unit increased to 12. So basically what NAV is showing? NAV is showing the market price of a unit of mutual fund. So this shows market price of unit of mutual fund. So let's say 1 year back you are paying 10 rupee per unit, now you are paying 12 rupee per unit, like that. So when you are selling, you will get this also as the return. Okay. Just write what do you mean by capital gain. Capital gain equal to increase in value of assets. Increase in value of assets. So that's why I've told you, you bought at 100 rupee. This is your asset, no share, and that is increased to 200. So increase in value of assets. This 100 is your capital gain. The other return I've told you is dividend. That is different. Dividend and interest is a return in which upon the capital you are getting. Dividend you are getting upon the capital. So this is an increase in capital. Okay. So what will happen if the share price are coming down? Here we have discussed only positive. If share price are coming down, this instead of this 12 crore or 10 crore corpus become 8 crore, then what is the value of 1 unit, 1 NAV or NAV? That is 8 rupee, right? So but this will not happen in case of mutual fund, because the experts are doing all the fundamental analysis and everything. But if a common man is doing, this may happen. That's the reason why you are investing through mutual fund. Otherwise you can directly go and invest in share market. Okay. So the idea is risk is very less because of the proper analysis by the asset management company AMC, and secondly, not in 1 or 2 companies. When individuals, when we are investing, what we will do? Hardly we will invest 2 lakh or 3 lakh or maximum 5 lakh, etc. Right? So this will be only sufficient to invest in 1 or the maximum 2 companies. But they will be investing in 100, 200 companies where the fundamentals are strong. So long term there will not be any problem. When they have huge corpus, they can invest diversified, right? So the risk is actually less. So for small investors, which one is better? Mutual fund is better. For large investor, you can directly invest, no problem. Okay. Now what is the oldest mutual fund company in India? Oldest mutual fund company in India? UTI, Unit Trust of India. Established in 1963, operational in 1964. It is Government of India's mutual fund company. Otherwise, you can see most of the banks have their mutual fund. SBI mutual fund is there, ICICI mutual fund is there. All these banks of mutual funds are there. Okay, now the need of mutual fund, if you see when you go for investment consideration, what all things you will see? First thing is safety, right? Second consideration is what? Return. Your money should be safe, you should have better return. Otherwise, inflation, let's suppose you have 100 crore rupee with you, okay? Then let's say if you have 100 crore rupee, there is 10% inflation. 10% inflation is there means automatically 10 crore is gone, no? Next year if you are keeping it idle. So because 100 crore rupee what you can buy today, if you need to buy that, you need to pay 110 crore. So if you are keeping it idle, there is of no use for this 10 crore. That is gone. It is having worth of 90 crore now only. So that is why you need to invest somewhere. So return also need to be considered. Third consideration, liquidity. For example, whenever you want, you should be in a position to get it. Okay, so mutual fund is giving you a perfect combination between these three. That is why mutual funds are more preferred these days. Okay, see, when you go for fixed deposit, you can go for FD. FD, when we talk about, you have safety, no problem. You have return. Better return is there, better interest rate is there, but do you have liquidity? No liquidity. Only upon the time expiry you can withdraw that, right? That is a problem. Okay, so or if you go for government bonds, and banks, it is safe, liquid also, but you don't have the return. Return is very less. But when it comes to mutual fund, it provides the best deal with all the three. Okay, although risk is there, a little bit risk is there, but still the risk reward ratio is higher. When you consider the risk reward ratio here, it is slightly higher, and liquidity is also high, because mutual fund is anyway always ready to buy and sell their NAV. It is not that you can sell it after some time or you can buy it after some time. No, that is not the case. Okay. So different schemes are there based on the combination of shares and bonds. It could be 60-40, it could be 30-30 or 30-70, like that. 50-50, different combinations are there. So there is no point in discussing all those things now. So that's about mutual fund. Any doubt in mutual fund? Can we move to the next one? Next, NBFC. All NBFCs are entirely different. These are heterogeneous groups. So next is insurance companies. Entirely different product is what we are going to discuss now, but under the same heading, NBFC. So you can write here, insurance companies collect money from public. Insurance companies collect money from public through sale of insurance policies. Through sale of insurance policies. What about mutual fund? They sell the NAV, right? They sell their NAV. So here they sell the policies, right? And this, by selling the policies, they will collect amount, that is their corpus. Like mutual funds are selling the units or NAVs and they are collecting the money, and that is their corpus. And here also this corpus will be invested in stock exchange. Okay, so now two types of insurance companies are there: life insurance and general insurance. You already know all these things, you know, but I will quickly go through this. First one, when you talk about life insurance, it will compensate only at the time of death, right? If it is life insurance, it will compensate only at the time of death. Okay, for example, a person is taking a, paying a premium, let's say 10,000 per annum premium, let's say for 30 years. Okay, so 30 years means how much? It is 3 lakh, right? 3 lakh. Okay, so this is what you need to pay. But when you are taking this premium, let's suppose you might be covered for, let's say, 10 lakh in case of death, right? So some insurance will cover the chronic disorders also, like cancer, AIDS, permanent disorders also. Some lump sum compensation is given. But in this case, if this person has taken this policy, 10,000 per annum, and for 30 years, okay, so let's suppose he is dying, he will get the entire coverage, right? 10 lakh he'll get. But in case if he is paying it for entire 30 years, this become 3 lakh. Okay, so once you took the premium, even after 1 year, you die, you will still get the 10 lakh coverage. Otherwise, you will get this 3 lakh. If after maturity, you can get this 3 lakh. Okay, this is actually an investment also. This life insurance is actually an investment also. Now, general insurance, if you see general insurance, you can write there loss of property, car, house, etc. Personal health, loss of property, car, house, personal health, etc. Okay, so health insurance also come under general insurance. Okay, so the medical insurance. So what is the difference between these two, life insurance and general insurance? Life insurance is actually a financial asset, right? Financial asset. That means after 30 years, in the previous case I have told you, he will get his money back with interest. So it's actually a financial asset. So whatever he invested, like 3 lakh, upon maturity he will get plus the interest, right? So, and if it is before 30 years, he will get the 10 lakh coverage. So that is why it is a financial asset. Okay, so it is an investment. But when it comes to general insurance, you paid the premium, let's say 10,000 you are paying for your car insurance. Okay, so you will not get this back if the accident is not there. Only you will get compensated in case of accident, right? In case of accident is there, or in case of any hospital cases there, if you have taken the health insurance, the company will take care of that. Otherwise, it is consumed. Okay, it is gone, right? So general insurance, when we talk about, it's a financial service. You are buying a service and end of it. But life insurance is a financial asset. Are you getting me? So life insurance is a financial asset. General insurance is actually a financial service. So this is financial asset, or actually an investment. Why investment? Because after the maturity you will get it with interest. It's almost like a recurring deposit. No, you are paying 10k every month. It's a kind of recurring deposit, and in case something happened, you will get the coverage also. Any doubt here? But the life insurance will be long term in general, and general insurance will be short term, max per year, like that. Okay, so the companies are also different. You can see in case of life insurance, LIC, ICICI, Prudential. When it comes to general insurance, within ICICI Lombard is taking care of it, and GIC. Okay, so LIC, GIC, ICICI Prudential, ICICI Lombard, etc. Okay, so you can write about LIC. LIC set up in 1956 by government by nationalizing all existing private sector life insurance companies. All existing private sector life insurance companies. Okay, see, many private insurance companies were there during that time, but most of them went default, and people trust were drastically affected. So in that context, actually government nationalized it. And remember, this insurance companies nationalized even before the bank nationalization. We discussed about nationalization of bank, right, in the previous module. So here you can see LIC. You write GIC. GIC established in 1973. GIC, General Insurance Company, 1973, by nationalizing all existing private sector general insurance companies. Again, there were a lot of default, so people trust was affecting like that. GIC established in 1973 by nationalizing all existing private sector general insurance companies. So that means after 1973, if you see, only government sector, public sector insurance companies was there. Okay. So now later I'll discuss why the private entry is coming and all. So if you see 1973, from 1973 for some period, it is only government insurance companies are there. But this GIC is actually a holding company. So it is a holding company of 4 companies. So there are 4 subsidiaries under GIC. What are they? Subsidiaries. What are they? You can write 4 subsidiaries. National Insurance Company of India Limited, NICL. So GIC is a holding company of 4 subsidiaries. So these 4 subsidiaries are selling the policies. Okay. So National Insurance Company of India Limited, NICL. Second one, United Insurance Company of India Limited. United Insurance Company of India Limited. Third one, Oriental Insurance Company of India Limited. Oriental Insurance Company of India Limited. Next one, New India Insurance Company of India Limited. So National Insurance Company of India Limited, United India Insurance Company Limited, Oriental Insurance Company of India Limited, New India Insurance Company of India Limited. Okay, then 1999 IRDA Act. So after that, insurance sector was actually opened up for private companies. So there is a regulator, IRDA. Okay, so Insurance Regulatory and Development Authority Act, IRDA, Insurance Regulatory and Development Authority Act. So now there is a regulator for insurance sector. So you can write after IRDA Act 1999, it was opened up for private companies. What is the main objective? Objective is to promote competition, right? So people should get more choices, and now you can see portability and everything. Okay, so people should get more choices, and FDA was also allowed. FDA was allowed initially up to 26%. Now it's you need to check this 49%, but please check this anyway. Okay, I have a confusion here. That is the reason why you can see Tata, AIG, right? AIG is actually a foreign brand. Bajaj Alliance. Okay, so Bajaj, these are alliance between domestic and foreign brands. Tata, AIG, Bajaj Alliance, etc. So IRDA was established as the regulator of insurance company. So as its name indicates, it is not only the regulator, also development, right? Insurance Regulatory and Development Authority. So that is why they are promoting competition, etc. So trying to develop this concept, not only regulation. Okay, not only regulation, development is also there. Now there is another concept, that is Ulips. Any idea what is Ulips? Can anyone explain this? Mahesh? Dilip? Any idea?
Unit linked insurance.
Yes, unit linked. You can write, my pen is not working. Unit linked insurance plans. Unit linked insurance plans. Okay, so where you have studied about unit? So this is unit linked insurance plans. This was actually a mains question, Ulips. Okay, so you can see here unit and you can see here insurance. So where have you studied about unit? We have studied about this in mutual fund. So this is actually a combination of what? Mutual fund and insurance, right? So it is actually a mixture of insurance and mutual fund. So here mixture of mutual fund and life insurance, but actually it is a life insurance in which the unit holders are provided with certain number of units. For example, if let's suppose person A, Mr. A is buying a policy. Okay, so taking ULIP, let's say he is investing this policy, this life insurance, he is investing, let's say 10,000. Okay, so this entire 10,000 will be in only for insurance purpose. Now it will be divided. Half will be for life cover and half he is getting units. Okay, so earlier I have told you 10 lakh coverage was there. Now this 10 lakh coverage will be reduced. So because out of this 10,000, maybe 5,000 is going for life cover, this 5,000 is going for unit. So in that context, let's suppose 30 years, okay, so his coverage will be like 5 lakh here, but here some units are given. So here what all things that we have discussed under MF, the same advantage he will get the dividend, he will get the interest, there is a change in units, so he will get a capital gain also. So all these are the advantage. So here both are happening. On one side he is getting insurance coverage upon his life, at the same time there is an investment. So the objective of this is, if in simple terms, the objective is what? Life cover plus return. So this is actually the objective of Ulips. And in 2010 there was a big issue, and this question was actually asked in 2010 mains only. If you go back and see, you can see this question. The debate was between IRDA and SEBI. What do you think will be the debate here? Who
will be the regulator?
Who will be regulating this, right? Because if it is life insurance, it has to be regulated by IRDA. If it is mutual fund, it has to be regulated by SEBI. So here both are there. So who should be regulating Ulips was the question. So finally the government decided that Ulips will be regulated by IRDA. That's why I told you in the beginning, it's actually an insurance policy where some units are also given. Okay, so it is actually an insurance policy where some units are also given. So it is the IRDA who's going to regulate. So it's a special type of insurance policy where life cover is there, return is also there. Okay. Yeah, other NBFCs I will discuss tomorrow. We will stop here. See, if possible, you send me all your mail IDs in our group so that I can get it easily. Okay, all of your mail IDs, once you registered, you send me in the group itself. That will be fine. Okay, we'll stop here today.
Okay, sir. Thank you.
Yeah, bye.